In many Australian cities, the gap between buying a house and a unit is sometimes over $300,000 difference, even in the same suburb. You might be in the place now where you've got a deposit saved and you're thinking, am I better off buying a unit now, or am I better off saving more money and buying a house? Or the third option is, am I better off buying a house in an outskirts suburb where it's more affordable, where I can get my foot into the market? There's a lot of conflicting information, and it does take into account what your personal objectives are, as well as what your lifestyle objectives are. And in today's episode, we're going to unpack, what does the data say? What has it said over the last 30 years? What has it said over the last 10 years? And what are some of the surefire ways you can make sure that your decision is going to help set you up for success? So in today's episode, I'm going to unpack what the pros and cons are of buying a unit now, or whether you should wait and save to buy a house, or whether you should buy a house in a market where it's more affordable. I'm going to unpack the costs of buying and also talk about what has the historical growth averages said over the last 10 years, and how can you make the best decision when taking that step in entering the market for the first time. I'm Steve Williams, and on this podcast, we talk all things rentvesting, property, and getting ahead. I've been a property investor for 16 years, and I've bought and sold properties across the country, both for myself and also for my clients. I'm the founder of W Property Advisory, and we help people get their foot into the market so they can start to get ahead. In today's episode, I'm going to be covering three things. Number one is, what does the data say about units versus houses? And what actually is a unit? Because is it apartments, townhouses, is it duplexes? I'm going to unpack all of that. I'm then going to talk about what are the, non-financial pros and cons of buying a unit. And then finally, how can you make a decision for yourself based on this information? We've got lots coming up, so stick through to the end. And I hope this helps you on your decision-making process, because it is a big decision and you want to make sure that you get this right, especially for the first one. Before we dive in and start to talk about the pros and cons and different situations there might be, I want to take a look at the data. What does the data actually say when the whole house versus unit debate comes up? But firstly, what is actually a unit? Now, a unit encompasses anything that's a part share of a property. So a house is essentially when, of course, it's a freestanding property and you own the entire block. Whereas a unit is when you have a share in the overall block. So this might be an apartment, it might be a townhouse, it might be a duplex, a triplex, etc., where you own part of the share of the entire property. Now, there's of course a big difference between like a duplex, where you might have two houses on two blocks that's been split from one, as opposed to a high-rise tower. So the bucket of units is really quite broad even without that. One of the debates with property is, does the land actually have the value when it comes to property? A lot of people, they chase big blocks of land. And in my opinion, it's not necessarily the size of the land, it's more so the location. And with property, if you are looking to chase capital growth, essentially capital growth is all an imbalance of supply and demand. So when there's an increase in demand and there's low supply, it means that prices are going to increase. And likewise, if there's an oversupply and low demand, then prices may fall flat. They may even go down. So essentially, if you are looking to buy in a location to chase capital growth, you really want to buy in a place where there's an imbalance in supply and demand. And essentially, you've got higher demand than what there is supply. So let's jump in and take a look from some data from CoreLogic. Now, there's a whole heap of data sources you can get. You can either do a Google search if you're wanting to dive into some of the data yourself, but let's take a look to see what CoreLogic says. Okay, so this chart here shows the growth of houses versus units over the last 30 years. So you can see from the 30 years leading up to 2022, over that period, house prices had grown by 453%, whereas units had grown by 306%. So if you had bought a house roughly 30 years ago, then you would have achieved on average 450%, 53% growth. Whereas if you had bought a unit, then it would have grown on average by 306%. So clearly, based on this data, you would have been better off buying a house. This also shows the gap between units and houses. You can see that it's just under $300,000. So of course, it means that units are way more affordable than houses. But a big warning, guys, because this is the aggregate data across the whole country. And I always like to say that there's markets within markets. Buying in a place like Docklands in Melbourne as opposed to Bondi in Sydney or Scarborough in Perth is going to give you totally different results. And we're going to dive into the suburbs in just a second and see how those growth rates have occurred over the last 10 years in those suburbs. Before we do that, I just want to look at what has the data said for the last year. Now, this is as of the 1st of April 2025. If we dive in to look at the current prices, you can see, so I'm just going to zoom in here, but for houses, the current median price across the country is $1,014,000. So quite a lot as opposed to units, which are $690,000. So that gap is now a little bit wider since 2022. It's now just over $300,000 in difference. But if you go down towards the city level, so across the table just here, we've got all of the different capital cities. Let's take a look, for example, at Sydney. So for Sydney, over the last year, the annual growth rate for houses has been 1.2%, whereas units has actually been 0.1%. So quite a big difference by about 1.1% between houses and units. If we take a look at Melbourne, we can see the growth rate was 0.7%, and for units, it actually went backwards by 2.8%. Now let's take a look at some of the faster growing cities across the country. Over the last year, Brisbane, Adelaide and Perth have done phenomenally well. We can see that the house prices in Brisbane grew by 7.5%, whereas the unit prices in Brisbane actually grew by 14%. So that means that the units actually grew almost 6% more than what houses did in Brisbane. Now let's take a look at Adelaide. We can see that house prices grew by 11% over the last year, whereas units grew at 13.9%, outperforming houses as well. Now let's take a look at Perth, 11.9% over the last year, whereas apartments and units have actually done 16.4%. So those three capital cities, the unit prices have actually performed much, much better than houses. Now, I want to unpack my thoughts on why I think that this happened. Well, these three capital cities, we've got Brisbane, Adelaide, and Perth. They did phenomenally well over the last couple of years. They definitely outperformed Sydney and Melbourne. Generally, what we see in property markets is when the house prices, surge and there's an excess of demand for supply, we see house prices go up. They go up, 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 and people realize that they can't afford to buy a house anymore. So they start to resort to moving into a unit, and that means they can get their foot into the market. So generally, it's a little bit of a lag time. So typically we see that house prices surge first. Of course, units are still, puttering along, but once house prices surge, then the demand for apartments and units then start to surge and follow after that. So if that observation is accurate, then we can see that's definitely what happened in Adelaide, Brisbane and Perth, because those capital cities, as I said, over the last 2 years, they did really, really well. And then following that, people then start to move into units. But let's take a look at Melbourne. Why has Melbourne actually gone backwards, minus 2.8% over the last year? It all comes back to supply and demand. If you go to Melbourne, you're going to see big towers being constructed in places like South Bank. You've also got the Docklands precinct, and all down St Kilda Road, there's a ton of apartments that are under construction. And when there's new supply coming into the market and there's no increase in demand, or the demand is fairly flat, then generally you're going to see that the prices are quite stagnant, or they could even go backwards, as we saw in the data there. All right, so we've looked at the city basis, but as I said, there's always markets within markets. So let's actually dive down into the suburb level and take a look to see how units have performed against houses. All right, let's jump firstly to Sydney, Bondi, probably one of the hottest markets for apartments across the country. So many people want to live in Bondi, right? So there's an excess in demand. If we take a look at house prices, we can see the median price is $4.3 million. And over the last 10 years, the compound annual growth rate has been 8.8%. That means on average, prices increased by 8.8% over the last 10 years. So that's pretty good growth, right? So firstly, let's take a look at Bondi in Sydney, a very hot market. A lot of people wanting to live there, excess demand, and obviously very low supply because it's very landlocked. And of course, we've got the beach, which is attracting people. So for house prices, the median price is 4.3 million. And over the last 10 years, the compound annual growth rate has been 8.8%, which means that it's done pretty well for houses there. Let's take it now a look at units. You can see the median is 1.4. So that's a huge gap, right? Much cheaper to buy a unit in Bondi. Still expensive on Australian averages, but let's take a look at the growth. So 5.2%. So what we can see here is that over the last 10 years, on average each year, that houses have definitely outperformed units. Now let's take a look at Docklands in Melbourne. It's right near the city, it's on the water, sounds fantastic, right? But there's always a bit of a running joke about Docklands if you're in the property world because it just really didn't take off how the developers thought it would. Now, there's no real houses in Docklands to compare, so we're going to ignore that. But let's take a look at units. So the median price for a unit is $615,000. You might think, where on earth in the country or the world can you be near a world-class city on the water in a nice new apartment? Well, if you look at the average growth rates over the last 10 years, it was 0.8%, so far short of Bondi, New South Wales. And that's really because there's an excess in supply and the demand is not very strong. Let's take a look now at Brisbane City. Again, there's not many houses in Brisbane City to look at, but unit prices, the average is $633,000. And on average, units grew by 2.5% on average. So look, it's a little bit better than Docklands, but still not fantastic. I now want to go to a little bit of a different market. Now, this is on the Gold Coast. It's Palm Beach. I was looking at this data recently and I thought, wow, what a huge difference. So if we look at houses, we can see the median price is 1.7 million and the average growth rate per year has been 11.5%. Whereas if we look at units, the average unit is $960,000 and the annual growth rate's actually been 11.5%. So that market's done really well. And again, it's all about supply and demand. So during the COVID times, there's a lot of people wanting to move to Queensland, live in a nice sunny spot against the beach, backdrop. And you can see that because of that, there wasn't enough supply. There was an excess in demand, so the prices went up. But if you look at this market now, if you look down this strip, you can see tons of properties that are under construction. There's all these new apartments that are going to open up. So for me, it's going to be really interesting to see whether these prices stagnate or could they actually go backwards as the supply catches up. Now I want to go across to the other side of the country. Let's take a look at Perth, which was the standout performer for the last couple of years. House prices, the median is 1.14 million. The annual growth rate over 10 years was 4.2%, whereas for units, the median price is $655,000 and the average growth rate was 2.4% over the last 10 years. So they've done okay, but certainly not as good as houses. As I said before, units are quite a bucket of different properties. It could be a duplex, a triplex, an apartment, a townhouse, a villa. All of these things are considered units. And of course, this has kind of grouped everything in together. So we kind of need to break down to the next level, which there isn't really much accurate data, but I can give you some different examples, of course, of properties we've bought for clients. I'll give you an example of a duplex property, so a unit that we bought for a client two years ago. It was a 4x2 on half a block, so the block size was about 350 square meters. We bought this one for $525,000, and in 2 years' time, the property had increased by about $180,000. So some fantastic growth, which will be well ahead of the averages that we saw for apartments. Probably similar to what it did for houses, maybe not as strong, because a lot of people, when they are looking for a property, they do want a standalone block because they don't want to have to share any common property or have neighbors over the rear back fence really close up. And the reason why this grew was because people couldn't afford to buy houses in this suburb anymore. To buy a house, you're looking at $800,000-$900,000. And so people who still wanted a house, they didn't want to be in a tower, they were able to buy this duplex and have what looks like a house, but it's actually a half block. Generally, what I say to my clients is if you've got your budget saved up, then if you're buying from an investment perspective, let's take the emotion out of it and let's look at the data. And let's find a location where you can ideally build your wealth sooner. So buying in a heavily supplied market like Docklands or even in Brisbane City is probably not the first best investment. You want to buy ideally a house in a location where the market is actually going to grow. So the question a lot of people have is, should I save more money or should I just get my foot into the market? Well, I'll give you an example. I had a client, he came to me and he had a deposit of about $80,000 and he wanted to buy a property. And he also had borrowing capacity limitations and he also didn't want to overdo it. What we found him was a 2-bedroom villa. It had a little bit of a land component, a little bit of a backyard. This villa, it was a 2x1, decent condition. It is an older style property, but it had been well maintained. And we're able to pick that one up for $420,000. We got a valuation recently and we looked at some comparable sales recently and we could see that that property was now over $500,000 in less than a year. So he's definitely accelerated his wealth. Whereas if he had bought like a, say, $400,000 unit in a market that grew at 2%, then that's about $8,000 in growth. So he's outperformed the average massively. In a nutshell, what I say to clients is that we start with the budget and then we work out what your investment goals are, or if it's something to live in, that's a totally different question. And that comes into play with lifestyle factors. Where do you want to live? What do you need to be close by? Where are you comfortable living? Because you may not necessarily want to live in an outskirts suburb of a city. You might want to live more in a city and therefore an apartment might make more sense. But from an investment perspective, buying in an outskirts suburb, you might actually do much better. What I often say to clients is that if you buy, firstly, a house, because generally they perform the best. Otherwise, if you can buy something that has a little bit of a land holding where it's scarce, like for example, a villa or a townhouse that's a little bit more in a city, that's generally going to do better than a high-rise tower in a place where there's massive amounts of oversupply. We've talked about all of the growth rates, and if that is your goal with buying the property, then hopefully that covers what you needed to know. Essentially, the answer is it depends. It depends on supply and demand factors, on whether you should buy a unit in a location or whether you should buy a house in another location. Because on average, houses across Australia grew at about 6.8% each year. So if you're buying an apartment where you're getting, say, 1-2% growth or even being flat, then it's really not a good investment. But let's consider the other factors. When you're buying an apartment, often what we see is sometimes the yields can be a little bit better. There's often a fallacy that there's huge rental returns on apartments. Some people think there's like 6-7%, which can be possible in some locations. But on average, the prices for units are slightly just ahead of houses, a little bit better yield. But you also need to take into account that with units, if there is common property or if there's strata fees, that can add to your costs as well. On average, we see that strata fees are typically anywhere from, I guess, nothing. Some places have no strata fees, which is fantastic, but you do need to look into that because it might mean they're not maintaining the common areas, or you need to make sure you have the right insurance coverages and stuff for that in the body corporate. But if it includes your body corporate fees and the management fees are quite low, and it also includes a little bit of an allowance for mowing of the common areas and maintaining and upkeeping the premises, well, that's a good thing, right? Because you want to live in a place where it's nice, it's being looked after, and it actually presents quite well. But in some facilities where maybe there's a pool, tennis court, a spa, a movie theater, and all of those things, that's going to add to the cost of your property. And in some really, luxurious properties, we're going to see that the strata fees or body corporate fees, or wherever you call them, wherever you live, they can actually go into the thousands, sometimes even hundreds of dollars per week, which can make it really costly to hold on to that property. And therefore, while you're getting a decent rental income, it's being eroded by these fees. There's also the fact that there has been some really shonky apartment towers being built, because the fact is a lot of developers, they want to throw the tower up and make their money. So if you're buying into a complex, you really want to check that the builder who built it has a good reputation and look at some of their older product or their older developments to make sure that they're not falling apart. And you've seen stories in Sydney and other capital cities where some towers have required some massive amounts of maintenance, and it's been really costly because essentially all the common areas and all the areas outside of your actual units within the complex, you're still responsible for that. You have a part ownership in that. So if things come up, then unfortunately you need to fork out the money as well. The other factor as well is sometimes if you get into a complex, you might have people that are on your body corporate that maybe you don't get along with, or maybe you don't agree with, or maybe they want to live in something really luxe and they want to have all the gardens manicured and topiaries and all of that. And therefore, that means that the cost of those strata fees is going to be much higher than just something that's kind of run-of-the-mill average. And if you're an investor, you're going to have a very different viewpoint as opposed to someone who lives in that complex. So that's just something to be mindful of as well. And finally, it's like, okay, well, I've got this money saved. Maybe you've got $80,000 to $120,000. Am I better off saving money and then buying something better, or should I buy now? Well, this all depends on how much money you can save. I guess the average Australian can probably save, a couple of $100s a week, and maybe you've got some side hustle money come in. Maybe you can save more than that. But if you're saving like $10,000, maybe $15,000 per year, the way that prices are actually going up, you might find that that money sitting in your account is actually going to be firstly eroded away by inflation, but you're going to miss the boat with property prices going up. Sometimes you're better off biting the bullet and getting your foot into the market with a unit, something in a growth location when you can start to actually get ahead, rather than waiting and then potentially being outpriced of the market. What's the optimal situation here, right? Am I better off buying a unit in the city that I live, or am I better off buying a house in a growth market in a fringe suburb? I did another podcast episode where I talked about my mistake in buying an apartment in St Kilda. I thought, look, it's like Bondi of Sydney, right? Bondi has done really, really well, but St Kilda has done abysmally over the last 12 years or 15 years that I owned that property. The prices have been very stagnant and it really wasn't worth buying that property. And I actually went back financially. So it was a bad decision. Where if I had bought a place in a location where the prices were going up, maybe I had bought in a fringe suburb of Brisbane, or even where I did in Canberra for the first one, I would have done much better because the prices there, they grew quite significantly stronger than what units did in St Kilda. Some of the properties we're buying for clients at the moment, they've been in suburbs where the prices have grown between 8 to 20% on year. And some of these locations, you can buy houses from as little as $650,000. Some of the big capital cities, you may be looking more at like the $700,000 to $900,000 mark. And we're not talking Sydney here, we're talking about Brisbane, Melbourne, Perth, for example. Adelaide as well. And these locations, you get your foot into the market at a price, say $700,000, $900,000, which is affordable for most people. And it means that you can have something that's scarce, have some land holding, and see some capital growth in the property. Well, guys, I've covered a lot today, and hopefully this has helped answer the question, should I buy a unit or should I wait and save up for a house? Remember to subscribe to the channel. We're also on Spotify and YouTube. So if you're listening in on Spotify, watch the YouTube if you want to see the data come up on your screen. I hope you've got a ton of value today. Until next time, let's rentvest and get ahead together. All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs, and speak to a professional.